overall, a lot of times people ask kind of like, hey, what's the what's the most common question I get is, hey, psst, don't tell anybody this, but what is your favorite setup? What is the highest probability setup that you use? And unfortunately, it's the complete wrong question. And the question I always ask is, what is your trading plan? And it's interesting because when I get the response back, I kind of know how long that person's been trading. And if they've been trading for over 5 years, they'll start going through their trading plan. If they've been trading for under 2 years, they're like, huh? What you talking about, Willis? Now, and that's actually, and Ben, that's actually a perfect spot to be in. 3 years, not yet profitable. You've got 3 good years under your belt. Good meaning experience-wise. And now it's time to take this to the next level. Okay? Tired of being kicked in the teeth. Yeah, and there was one time I was giving a talk, and somebody had asked me, and they're like, well, how did you get to the point, where you stopped, because it's frustrating, obviously, as a trader. We want to trade for a living, and the market keeps kicking our teeth in. But at some point, you just get tired of it, and you get tired, pardon my French, but you get tired of the bullshit, so to speak, and you're like, all right, let's do this for real. How does a trader do this for real? And as retail traders, we don't get that. We're just kind of like, hey, here's a computer, put some money into an account, and good luck. And it's just a disaster in the making. Nice, Brad. That's awesome. Yeah, and the good news is too, and I'll see people there like, a lot of, and you guys are going to be trading all different kinds of accounts. It is the bigger your account, essentially, the more there are advantages to having a bigger account, but there are also advantages to having a smaller account too. The main advantage in having a bigger account, of course, is that you could generate more income if you wanted to do this full-time as a living. I know some of you in here are already doing that. But as a small account, you have you have the advantage of just the liquidity, just being able to get in and out of it, anything, which is something that hedge funds can't do. And that's why large hedge funds are ecstatic with 10% returns a year. As an individual trader, we have opportunities to generate a much higher return. But to do this, you've got to have a plan for trading for a living. So that's what we're going to talk about today. And without further ado, we will just jump right into that. Okay? So trading for a living. So welcome to the Trading for a Living class, and I'll be the first one to tell you guys that we're going to have a lot to cover. It's going to be like drinking from a fire hose. Now, this will be recorded. A lot of people will ask that. Two, you are going to get a copy of this presentation. Okay, so you don't need to sit there and scribble. In fact, I would encourage you not to sit there. If anything's being shared here on the PowerPoint, you don't really need to write it down unless something really hits home with you. It's what I call those aha moments. And you thought, wow, that's something that could really have an impact on me. You can jot it down, or jot down the slide that it's on. And in fact, I could help you with that. Just say, let me add slide numbers on this. Transition, slideshow, insert picture, clip art. And I'm just adding the slide numbers. There we go. And then that way you can just jot down the slide number and go back and reference it that way. So the other thing, so I would suggest, you don't need to frantically take notes. Okay, just sit back and listen. A lot of times that's the best thing. I've done this for a long time. I swear I know what I'm doing. And what I ask from you on this is just be patient. What's going to happen is as I'm talking, you're going to have a lot of questions. Okay, and I guess my favor to you is just to say, you know what, hey, let's hold off on the questions for a couple reasons. One, I do have a lot of material to cover, so if I spend all my time answering questions, I might not be able to cover all the material. And two, what I found is I'm most likely going to get to your question at some point during the presentation. Okay. To be clear, that this is not a class about specific setups. I'm not going to be talking about what a squeeze is. If for some reason I talk about a setup and you don't really understand it, We'll direct you to customer support where they can get you a copy of the DVD, a list of the classes that we have that cover that stuff. It's really, though, the macro view of trading for a living and what that means. Okay? And of course, at the end, I will take some time to answer questions, and we will provide a follow-up email for questions. And then at the end of my presentation, which I think I'll be good for about 3 hours or so, I'm going to bring in a guest speaker to go over the software that we talked about. It's the software I use. You guys may know him, Marcus Highcotter. He's created it, and he's got a very German efficiency in terms of going through and how he tracks everything. And it's great stuff, and he can show you that. Okay? Hey from Prague. Okay, so I do not want to delete that recording. All right. So now let's do this. I don't know if you guys have seen Anchorman. It's funny, the first time I saw that movie, I thought it was stupid. But there's some movies, anytime you see them again, they get better and better. And Anchorman is one of those. But it's a pretty good one. All right. So trading for a living. Everyone, here's the thing. Everybody that comes into trading, they come in different ways. But everyone has the same objective. Okay, I've never met one person who said that I want to trade to lose money and destroy my self-esteem. No, I've never had anybody be that's their goal in trading. No, that's what happens to a lot of people. The goal is to make money. Okay, yet most people who take up trading lose money and throw in the towel early, and in my opinion, too early on in their journey. And it comes down to a couple of factors, and the first being, this is fail to plan and you plan to fail, which is kind of a generic kind of a thing, but it's one of those, if it really hits home, it's a game changer. If you fail to plan, guess what? You've already planned to fail. You are not going to succeed. Okay, and that's something that's something to keep in mind as we're going through this. So congratulations, you want to trade. So my advice is to plan big. Okay, there's no reason to think small. Plan big, and if you fail to plan, know you are planning to fail. Failing to plan means planning to fail. Planning to fail. If it's important, and this is just the facts of life, if it's important to you, you're going to find a way to make it happen. If not, you're going to find an excuse. And anytime I hear somebody giving excuses, I know that it's not important to them. There are just some people that they don't care what happens. They will do whatever it takes to get it done. They don't bitch. They don't complain. They get it done. The other people, honestly, a vast majority of the population, all they give you are the excuses of why they're not doing what they want to be doing. And it just means that it's just not important to them, okay? And that's what it comes down to. If it's incredibly important to you, you'll force yourself to overcome your limitations, overcome your fears, overcome the choices that you're making in your life that are causing you to not be able to do what you want to do, okay? You know, if you're drinking a 12-pack every night, you might want to cut that back, that kind of stuff. I mean, there's a method to the madness. And it's interesting like this, and if you've never read a biography of a person who has been known in history, like a Winston Churchill, or somebody more modern, like an Arm & Hammer or something like that, and it's interesting because you see how they conducted their life. They didn't screw around. It wasn't like, oh, I want to watch TV 6 hours a day, and I want to make sure I'm having fun, and I want to take care of myself. It was, no, these are my goals, and the audacity with which they pursued those goals to me is always fascinating. There's a story of, there's a story of Arm & Hammer, who was a businessman, and I thought this was fascinating because in the he's passed away, but it's like the 1920s or 30s. It was the 1930s actually, during the Great Depression, and his dad was a doctor and he wanted to be a doctor. And something happened where, I don't know if it was his dad or his uncle, somebody died, but they had a pharmacy, and as part of the family business, he was expected to help out. But he had a problem. He was also enrolled in medical school, okay? So here he had medical school. His dream was to be a doctor, okay? And then over two, here's a business, so this is medicine, and over here is a business that his family expected him to take over. Both of these are full-time jobs, okay? 2 full-time jobs. It's impossible to do both. He had to choose, but instead of choosing, he came up with a plan, because being a doctor was important to him and running the family business was important to him. So what he did is he found the most brilliant student in school who happened to be poor. And then he paid the guy a salary from the business to take his classes for him and take notes. He'd spend the day running the business, and then at night, instead of going out and partying, he would study the notes. And he did this for 4 years, and during these 4 years, he graduated and became a doctor, and he took this business and turned it into some crazy thing. He started making a lot of money in the business, and eventually just went into business. But what happened here, and what I loved about this, was an example of, my writing no longer looks like a first grader. It was an example of, if it's important to you, you will find a way. Okay, another example of this, Arnold Schwarzenegger, some of you may have heard of. When he was 18, he was in the Army, he was a bodybuilder. His dream was to win Mr. Universe, okay? That was his dream. There was a competition coming up, but he was in the Army and he could not leave, all right? But this was really important to him, so what did he do? He snuck out, he jumped over the fence, he went to the competition, he played second place, and when he came back, he got caught and he got thrown in the brig. So what happened? Well, after a couple of days, they came to him and figured out that, wow, what you did, we're proud of you. You are now, then his orders were to train all the time. So even though he broke the rules and did this, it came back that, you know, it essentially worked out. If it's important to you, you'll find a way. If not, you'll find an excuse. And there may have been other people there that wanted to go compete. They're like, oh, I'm in the Army. Of course I can't do that. And it's such an important mental attitude, and that's what I've always been fascinated in. If you read biographies, you'll find examples of this throughout history as well. And there's always going to be those moments in time where you can make an excuse and turn on the TV and crack open a beer, or you can step up and knock out what is important to you, okay? Period, end. So the business of trading, first and foremost, with the discussions made in this section, realize that I am not an accountant or an attorney, and the rules change all the time. That being said, I'm going to share with you what I do and what I've learned, and this is stuff that fascinates me. Each state and, of course, country has slightly different rules. Now, I know some of you are from overseas. I don't completely understand how the rules are in England or anything like that, and I know they're similar, and I know I've talked to people who have done similar things there too. You have to set the stuff up through a qualified accountant or an attorney and get their okay, or you could most likely screw it up and get in trouble. You've got to let the professionals handle this. If your accountant has no clue, and if you're going to HR Block or you have what I call a normal accountant, then they probably don't have a clue, then these two are very good. I've heard great things about Traders Accounting. I know Robert Green. He's helped me out with some stuff. These are both fantastic resources for traders, and they're economical, and they will guide you through the kind of minefield maze in order to get all this stuff set up, okay? So the question is, nuts and bolts, do you trade as an individual or as a business, or do you file under trader status, okay? Individual is pretty straightforward, and this is what most people do, and this is how they start off doing it. You open up an account in your name. You deal with wash sale rules. I'll give you a definition of that to follow. And your losses are limited to $3,000 per year. That's in the USA. I don't know what that is in other countries. Wash sale rule in England, I believe, is called bed and breakfast. I'm not sure what that means. I'm sure there's some pun there. If you lose $30,000 trading and then quit, you get to deduct $3,000 a year for 10 years. Okay? The maximum amount you can deduct is $3,000 per year. However, if the next year you make $40,000, okay, you pay taxes on only $10,000, meaning that the loss is carried forward year to year. So the good news is, if you've been trading for a couple of years and you've got a lot of losses, and hopefully you've been tracking those and those are on your tax returns, that now you're going to put together a plan and start making money. Your gains will be tax-free until you wipe that out. Okay, so that's a good thing. I mean, it's not really a good thing because losing money is not good, and opportunity costs and all that. But that is a positive. So think about that as tax-free money until the losses are made up. Now, if you lose $500,000 and you throw in the towel, then you get to deduct $3,000 per year until you die. So if you live another 50 years, that is $150,000 in deductions, leaving $350,000 in losses when you die. Sorry to be so morbid. Any unused losses left over after you die become worthless, as these cannot be passed on to your heirs. Okay? I don't know about you guys. I think that's just insane. This is a picture of my grandpa when he found that out, and then his son. What do you mean you can't leave me your, what do you mean you can't pass on your unused losses to me? And I've got a lot of people there saying that they use Robert Greene and they like him a lot. Yeah, he's great. So to me, that is just a ridiculous law. So long story short, if you're trading as an individual, it is the absolute #1 worst way to trade, okay? That said, now, it is also the easiest way to get started, and oftentimes it actually makes sense if you have a small account. And I'm talking about regular accounts here. Retirement accounts require a little, those kind of have to be traded individually. There's some things that you can do with that. But the good news is you can file for tax trader status and have that apply retroactively at least for the prior year, and sometimes you can actually go back a couple of years. Now, for those of you that don't know what a wash sale is, that's just selling a stock for a loss. And what used to happen is, like in the 1930s or so, December 31st, somebody would sell a stock for a loss, and they'd buy it back on January 1st. So they got to deduct, and back in the good old days, you got to deduct the entire loss from your income. So you deducted the loss, and you're right back in the stock, and you're off and running. That's called a wash sale rule. So the governments do not let you do that anymore, at least in the USA and the UK. With a wash sale, the disallowed loss is added to the cost basis of the new purchase. So that's what happens in a wash sale if you're trading as an individual. Now, with an LLC or a tax trader status, traders typically save about $8,000 per more or year on taxes, with the ability to handle write-offs and have carryback net operating losses. Yeah, now someone just said that they're switching back to individual from tax trader status because you do have to do like 50 round turns a month. Well, guess what? If you do it in an LLC, you can still get the benefits and you don't have to trade as much. Okay, so we'll go through that. So with an LLC or tax trader status, so essentially what tax trader status is you can do this as an individual, okay? Or you can set up a company. So option 1, set up a company, an LLC. Option 2, set up tax trader status. And option 3, you can even have the company set up as tax trader status. Tax trader status, well, we'll get to that. Now, one of the big things here is that you have the ability with an LLC to handle write-offs and have carryback net operating losses, which is called NOL. If you have a great trading year and you pay taxes on the gain, and then the next year you have a huge loss, as an individual you can't deduct the loss, and you can't go back and refile returns and deduct that loss. But as a business, you can refile your prior year tax returns, carry back those losses, and actually get a refund. Okay? So if you didn't know that, yes, that is awesome. That's something that you can do as a small business, and if you set this up as an LLC, you are a small business, and you cannot do this as an individual. So there definitely are some advantages to being able to do that. Now, you can set up a limited, here's the main nuts and bolts, at least what I do and a lot of traders I know do. You can set up a limited liability company, which is an LLC, as your trading entity in the state in which you live. Now, there's really not an advantage to doing this in Nevada or Delaware or anything like that. Just set it up in the state in which you live. And the reason for that is because it still qualifies as capital gains. Your goal here is to separate your trading capital from your personal investments, such as real estate. Okay, and this will also help with you with establishing tax trader status if you do that. If it's just you, you will be the sole managing member of your trading entity. This is known as a single member LLC or SMLLC. Now, this is important. It is also effective that once you form your single member LLC, to file your LLC as an S Corp. Now, the good news is all the stuff I'm telling you, if it's going over your head, the 2 accountants I showed you, they know how to do this. Okay, and it's not expensive to do. As an S Corp, the business files its own separate tax return instead of you putting everything on your Schedule C, and the IRS likes that, because the Schedule C is always a red flag for excessive deductions and things like that. But if it's set up and files its own return, it's considered more of a legitimate business. And of course, you have to make legitimate deductions, or as legitimate as possible. This is strictly for tax purposes, as it makes the itemizing process easier. If you don't do this, then you have to put everything on a Schedule A, okay? And those deductions are limited to a % of income, which is another great scam. So clearly, in terms of, if you're setting up a normal account and you want to do this for a living and it's not a retirement account, there's a lot of advantages to setting it up as a company. Now, once you create the entity, you file for an EIN, which is the Employment Identification Number, and then this number will be used on your trading accounts and your tax forms, as this is how the IRS will identify your trading entity as a separate from your personal social security number. Okay? In other words, this makes it legit. With this, positions are marked to market, meaning that wash sale rules do not apply anymore. Okay? That's a positive. You also get to deduct all trading-related expenses, and you can deduct losses in excess of $3,000 against ordinary income. Yeah, and Robert's saying, you should tell them you're not an accountant or attorney. And yes, Robert, I did that in one of the slides about 3 or 4 slides ago. Now, yeah, and setting up, you're going to see those ads like set up your own Nevada Corp. It's tax-free. It's state tax. So like if you live in Texas, they don't have a state tax either. But as you'll find too that you'll just, well, hold on here. Okay. Now, you don't actually have to set up an LLC to take advantage of those benefits. You can qualify instead as having tax trader status as opposed to being an investor. Now, this is easier said than done. I personally think forming an entity is a good idea regardless, but with the LLC, gains are still treated as capital gains, so they aren't subject to any self-employment tax. Okay? The only self-employment tax you'd be subject to is if you paid yourself a salary from that entity, which of course would be taxed as regular income. All right, so that's also a benefit. Now the trader tax status is actually a better deal than trading as an individual if you qualify, but it is actually difficult to qualify. You will not qualify if you're trading retirement funds. Okay, now this is trader tax status. Anybody can set up an LLC. If you're doing automated trading, that doesn't require much work on your part, or you're working with a money manager. However, all of this can be done with an LLC. Also, trader tax status is you're actually a fairly active trader. I believe you have to do more than 42 trades per month. Okay? And again, and the idea with this, and again, talk to the accountants. They'll set you straight on this. But you can actually go, it's like, okay, I'm just going to qualify as an individual as trader tax status and take advantage of this stuff, or I can set up an LLC. And the LLC is generally, I think, an easier way to go. If you trade your own account full-time as a day or shorter-term swing trader and have a material account size, then you can qualify. All right? So the key with this is you want to treat this as a business. So what would you do if you opened up a coffee shop? Well, you'd incorporate. You'd set up a business checking account. You'd get a business credit card, and you'd deduct any expenses associated with that business. You're going to do the same thing with your trading business. Set it up and be legit in the eyes of the law, and you will suddenly make a mental shift and be legit in your own mind as well. Plus, you're going to have much favorable tax treatment, and that is a real expense. In sum, it's generally a good idea to set up a single-member LLC and elect it as an S-Corp. You can also get trader tax status for this entity for added benefits, okay? And you can do this for yourself as an individual or as an LLC. This is all a pain in the ass, but one thing rich people have learned to do is lots of paperwork. Tax laws prey on the uninformed and the lazy, okay? And if you want to stay uninformed and you want to stay lazy, then you're going to pay the maximum amount of tax that's out there. The way the government works and the way the government incentivizes its citizens is through the tax law. If it wants its citizens to go out there and build low-income housing, then they're going to give a ton of tax breaks for people who do that. If they want its citizens to go out and discover oil, it's going to give a ton of tax breaks for people who do that. Okay? The more you understand that, the more you do things in accordance with what the government wants you to do from a tax perspective, not necessarily from other perspectives, the better off, honestly. It's just how that works. Everything I've talked about is based on a non-retirement account. Retirement accounts are different, and you'll need to talk to an accountant familiar with those trading rules. To set this up for an individual or retirement account, you must pay for professional advice in order to be in compliance with ever-changing rules and regulations. Everything I just told you is current as of recently, but that could have changed yesterday, okay? You cannot do anything that I've talked about in here without talking to your accountant or talking to a lawyer and making sure that's in compliance and that you're doing everything correctly. Because even if you try to save money and file all the forms yourself, if you don't check one box that you're supposed to, i.e. for like an S-Corp election, that can hose you for years down the road. Don't be scared of this. Just have a professional help you. It's not that expensive, and you'll be on your way. One question there is, so a couple questions that are coming up. Would a C Corp work? Again, that's a question for an accountant. In my experience, C Corps are more of a hassle and don't offer the same benefits. But again, that's something you need to ask your accountant. And then why first an LLC? Why not just set it up an S Corp? So an S Corp is just a designation. So you can do like a corporate, set up a company, whether it's a, and then you can actually just designate it as an S Corp, which is flow-through status, or C Corp, which is something that stays within the company. But the stuff that I've talked about here is fairly common knowledge in the trading industry for people who are setting up companies. LLC, get S Corp status, and bada boom, bada bing. All right, so congratulations. Now you have your entity. And I like this cartoon here. This kind of reminds me of tech support. And the lady saying, okay, I grab the mouse, I close the window. So here's the mouse, close the window. Now what do I do with my error? And it's kind of what happens a lot of times is people will get into a situation like this and then they're not completely sure what they are supposed to do next. The main thing here is that the more you treat trading like a regular business, the better you're going to do for a lot of reasons, which we're going to start getting into. Let me change some of these colors here. Blue. So if you're not willing to take this first step and actually start treating this like a business, you will be one of the 90% of traders who lose money over time, who are just looking for thrills or who are trying to be right instead of generating income for their trading business, which is this is a big thing that I see in traders, trying to be right, looking for thrills, looking for the excitement, instead of treating it like a business and looking at the problem of trading as a business and how a business would determine how to generate revenue, okay? So a big part of this is planning. You need a business plan, a model on how to run the business, in addition to a trading plan, i.e. what types of trades to make, what type of trades to take, and I'm going to cover those two today. Most traders do neither, and this is what I want you guys to realize. These are your clients. They create a constant, steady stream of losses with which you and your business model can vacuum up, okay? You are creating a business solely to capture this money that is flowing out of their accounts. That is the reality of trading. And the quicker you understand that and get your arms wrapped around it, the more your own trading business is going to thrive. So as a trader, you have to keep in mind that the only way to make money is when someone else loses. Now, I always like to think that it's a market maker losing money or it's some junior kid on a hedge fund in Wall Street, but the reality of it is yep, sometimes you're going to be taking money from your neighbor. It doesn't make it right or wrong, it's just the way trading works. You make money by taking the opposite side of trades that don't work out for someone else. Guess what? Every time you lose money, someone else has just made money off of that trade. Someone always takes the opposite side of the trade. So if the last 3 years you've been trading and you've been losing money, you've made someone very wealthy. That money did not disappear. And now it's time for you to get on the same side as them. because there's always going to be a steady stream of interest in the markets and people trading, and sometimes it's just newer people, but sometimes you have big hedge funds that get in trouble, okay, and they're in too big of a position and they get stuck and they can't get out. Tesla is a good example. A lot of hedge funds have been short that stock. They've made more money trading that stock long than anything else this year, you know, buying call options and things like that. And it makes me feel good because most of that money has been sucked out of hedge funds into mine and our personal accounts that we've been following those trades. Now remember, most people think that the trade they're in right now is going to work out and make them a lot of money. That is their mindset. Okay, let me say this again. Remember, most people think the trade they're in right now is going to work out and make them a lot of money. This is their mindset, and that is your business opportunity. Okay? And it's to understand here that as a business, this is the opportunity. If you own a coffee shop, your opportunity is to get people hooked on caffeine and have them coming back for repeat business. If you're setting up a trading business, your opportunity is understanding that psychologically people think that the trade they're in right now is going to work out and make them a lot of money, and that's their mindset, and that's what's going to cause their mistakes, and that's the opportunity that you have to come in and make money. I always like this. I always think, like, you know, when I wake up in the morning, I'm going over my trades that I want to do. I just think, okay, you are taking this trader's money. And here's a cat balanced on a ledge. Here's a balloon. And the cat's thinking, I can see no way in which this carefully laid plan could ever fail. And this is what 90% of traders do. They get into a trade, but they never plan for disaster. And there's always going to be disasters. There's always going to be news events that ruin your position. Always, always, always. Yeah, the market is definitely not your friend. So in terms of a business plan, now if you're going to, you know, open up a pizza restaurant, there's other models out there that work. Domino's did a good job. You know, if you're going to open up a sandwich shop, go check out a Subway. They've figured it out. You know, there's no need in many cases to reinvent the wheel. You just take what's been working and add to it or plan to it or make it better. The dirty little secret of almost any business, you know, especially restaurants, coffee shops or whatever, is if you just do something 10% better, you're going to start taking all the business away from everybody else. It's as simple as that. And it's the same thing as in trading. There is no need to reinvent the wheel. What is needed instead is the adaptation or adaptation, whatever the right word is there, of an existing successful business model to the career of a trader. And there is one out there to emulate. And successful traders all follow the exact same business plan as a casino. Okay, this is a successful model. Successful traders apply this model, and this is the model that you want to use for your trading business. So now we've got to understand, what is their model. The first thing to realize with a casino is that there is a reason why a billionaire cannot walk into a casino, get $1 billion in chips, and put it all on the pass line in craps, or, you know, bet it all on black and roulette, or bet it all on the next hand of blackjack. Why? Well, first of all, if the billionaire lost, that would be amazing for the casino. It could change the casino's life. But if the billionaire won, it would break the casino. And the casino is not willing to take that risk. This is important as a business model. A casino is not willing to take that risk. Yet traders all the time will see a situation where only one over-leveraged trades can blow out a trader's account. It either blows out their entire account or half the account or just way above and beyond what their plan was, and this can ruin months and even years of winning trades. Okay? Casinos have a successful business plan that works. Most traders don't. This is one of the rules in our business plan that we have to adapt. So yet, while traders let this happen let this happen to themselves all the time. It never, ever happens in a casino. Casinos have specific business practices in place to prevent this from happening to them and thus putting them out of business. Because a casino realizes if they're out of business, they're going to go out and have to find a real job that's not fun. And it's the same thing as a trader. If you lose your account, you're going to have to go back to work, okay? You're going to have to go back into the corporate world, or maybe you're already in the corporate world, but then your dream of escaping isn't going to work, whatever it is. But if you blow out your account or you do something like this and you break this rule, this is not going to happen for you. And it's just important to realize what a successful business model does, and they have rules in place to prevent this from happening. So how do the casinos fight this? How do they fight the billion-dollar bet? With a sound business plan, and this is why you always see the maximum bet size in casinos. You might go to a blackjack table and you'll see that it's a $25 table, but the max bet is $5,000. And there's a couple of reasons for this. One, they don't want you to keep pyramiding your gains. So say you bet $25 and you lose, then you bet 50, and then you lose, then you bet 100, and then you lose, and then you bet 200, and then you lose, then 400, and then you lose, and then 800, and then you lose, and then 1,600, and then you lose, and then it's like, oh my God, 3,200, and then you lose. Well, suddenly, from here, you can't go bet 6,400 because now you're at the thing. So what happens is that this does happen to people who employ that. This is the same as martingaling, and they blow out. It doesn't happen, it only has to happen once. And the casino knows if they didn't have a limit, some people could come in and just do this all the way up until they got back their original capital and $25. Well, the casinos are smart. They prevent that. They also prevent the idea that you can come in and just bet it all at once. Now, $10,000 may be a lot of money to an insurance salesman. That may be his whole stake, and he can come in and bet $10,000, but that's not going to break the casino, okay? So by forcing the billionaire to take many, many small bets, the casino knows the probability is in their favor to take all of the billionaire's money, okay? Not some of it, all of it, every dime. This is called a table limit, and in trading, this is called price risk management, okay? And this is one of the things, especially if you're selling premium, is it's better to sell a lot of premium in little bits and pieces and do it often than to bet it all on one idea. You got a $50,000 account and you max out your margin and short Tesla puts. Well, it might work out, but if it doesn't, it could get very ugly. So then the question comes up, well, can't I just bet it all in the next hand? Because as traders, we're going to go through that scenario, and all of us have the fantasy of, gosh, I wish if I just knew that Tesla was going to gap up after earnings, I would have put my entire account in those out-of-the-money calls. Yeah, of course, if we knew, we would do that, but we don't know. And we all, traders kind of start going through those calculations and thinking, gosh, I had a $30,000 account, now I'm at 20, and I'm going to do this big trade, get my $10,000 back, and then I'll keep going. And casinos won't let that happen, and their business model is sound, and they make money year after year after year. And so as a trader, you can't let that happen either. And my advice for someone that says, because I've talked to a lot of people that they just cannot get over the losses that they've had. They carry them like an anchor. My advice is to give yourself the gift of a clean slate. And there's a book, gosh, let me remember this. We've got this on the website too, but it's a really good book, and there's a chapter in there on Abraham Lincoln. And I think it's called The Traveler's Gift. Let me make sure. Yeah, so if you've got losses and you're having trouble forgiving yourself, read this book called The Traveler's Gift. It's a great book. There's a chapter in there on Abraham Lincoln, and it's pretty amazing. And I mean, it's a short book, and it's got more stuff in here in terms of just kind of getting you in the right mindset for moving forward than anything else I've ever read. And it's entertaining. It's based on history. Yeah, it's a good one. Okay, so business plan. So this means that when we're faced with a loss, we control it through stops. And one of the things, and you guys should know this by now if you've been trading for a while, and the fantasy of every trader, especially engineers, is that they don't have any losing trades, that they can filter out losing trades before they happen. All they got to do is add one more indicator. That's impossible. As a business plan, what we have is that when faced with a loss, we know that we're playing probabilities, and we can just control it through stops. We don't freak out and let it go against us for a massive 5- or 6-figure loss, okay? And that's the key. I can tell you, getting out of losing trades is amazing because you immediately go back to that neutral mindset. You can always go back in. But if you're in a losing trade, all you're doing is focusing on that losing trade, and that just puts you in a mental state where you can't even react correctly. So in trading, of course, you do have to bet to win, but you have to have chips in order to bet. And that is the simplest part of the business plan, putting rules in place to prevent the ruination of your account. And I've discussed trader psychology in detail in another class, but a little later in this presentation, we will go over briefly on why humans are predisposed. Sorry, I'm like stuttering my words this morning. Predisposed to let losers run in a moment, because you're going to actually incorporate that into your trading plan. Now, casino owners don't become depressed when players win, just as traders shouldn't become depressed when they have a losing trade. Instead, casino owners continue playing the probabilities and managing the risk, and they adhere to this 24/7, 365, 24 days a week, 24 hours a day, 7 days a week, 365 days a year. They never abandon their plan, no matter how good or bad their results are on any given day, week, or month. Now, in trading, we call this discipline. And I was just recently in Las Vegas, and I was playing blackjack, and I was actually having a really, blackjack is just pure luck. I know the rules of the game, and then after that, it's luck. And we had a run where I think we won like 16 out of 18 hands, which I don't think has ever happened. And the chips were stacking up. They just let us keep playing. Have you ever been winning money at blackjack when suddenly the pit boss comes out and changes the rules? No, they want you to keep playing. And I can't remember exactly what the numbers were, but I had my original stake. It went up like 6 times, and then I just raised my stop. I just raised my stop up to 4 times, and it got hit, and I got out. They were hoping, of course, that I would just keep playing. But one of the best ways to keep money at a casino is to trail up a stop and stop playing when it's hit. And of course, that's the best way to keep money when you're trading too. In a casino, if you're a player, what you want to do is that if you start with 4 chips, so 1, 2, 3, 4, and then suddenly 1, 2, 3, 4, 5, 6, 7, 8, suddenly you have 9 chips, you take your original chips and put them in your pocket, and then you can play with these other 5 chips. And then if luck comes down a little bit, if you hit this, you're out. If it goes back up, you make another 4 chips, great. You take the profit out and put that in your pocket. And it's actually the same thing that you want to do when you're trading as well. So what about revenue to equity? And this is one of the biggest questions I get is, all right, John, I've got this much money to trade with, and it doesn't matter what it is, $10,000. Obviously with $10,000, it's going to be very hard to make a living on unless, you're living in your parents' basement for free and they're buying all your food. And it's good to get a realistic idea of how much money you can make each year on your trading account. But first, before we go over that, you've got to understand and address your potential expenses, because believe it or not, this is what destroys most accounts. Yes, losses destroy accounts, but if you're a good trader and you're getting into a rhythm, after that, it's the expenses that destroy your accounts, okay? And in this regard, we want to look at expenses from a business point of view, okay? So expenses are both obvious and not so obvious. Obvious expenses are computers, data feeds, software, subscriptions to information, books, office supplies, classes, alcohol, that's a joke, Starbucks, half a joke, travels to conferences, etc. Those are normal kind of expenses day to day. Not so obvious is commissions, and this is a huge expense. Let's say you have a $20,000 futures account, you're paying $5 a round turn, you trade 3 contracts at a time you trade 10 times per day. This translates into $150 per day in commissions, $750 a week, or $39,000 a year. $39,000 a year on commissions and a $20,000 account. You guys do the math on that. You have to make a lot of money just so your broker can drive his Ferrari. And yes, you read that last bit correctly. Commissions are the big expense, and they are rarely paid attention to. And if you aren't careful, they can exceed your starting capital, meaning you would have to make more than 100% per year to just break even. And that's ridiculous. You have a $20,000 account, you make $20,000 in profits, but you end up giving $20,000 in commissions to your broker, you're left with $20,000. That's insane. Brokers are smart about that. Commissions are hidden costs and that they're factored into your trades. And you don't even, because you don't see them on a credit card or anything. And this used to be the big thing with Forex, commission-free trading. Well, what they did there is they had these ridiculous spreads that were even worse than the commissions, but because traders didn't see them, they thought it was free, and it was not free in any way, shape, or form. So your first task is to actually get and keep your commissions as low as possible. Now, the obvious way is to start shopping around for the lowest rates. And you could and should ask your broker for a lower rate. Okay? In general, the more money you have and the more you trade, the cheaper you'll be able to get your commissions down. But this actually isn't the most important part of this business plan in terms of getting commission costs lower. Now, I will tell you, I do work closely with a lot of brokers. The brokerage business is fiercely competitive. They are, especially if they're public companies. Their share price is a reflection of how many new accounts that they're opening and how much their commission revenue continues to increase. And one of the best things you can do, and it's tough because, you know, like we all like the brokers that we're using, but sometimes you just have to call up and threaten to leave. It's like, hey, you know, I'm going to go over to this account and set it up and yada, yada, yada. And not even make it as a threat. Just call up and say, yeah, I just need to talk to somebody. I need to wire my money out. And they're going to be like, well, why? Well, I'm closing my account because I found a cheaper broker. And a lot of times they'll start the dialogue. But yeah, you definitely want to give it a shot. But essentially, you know, if you're trading a small account, you don't trade very much, you're not going to be able to do much with that. But that's okay. It's actually not the most important part of this. A big part of this is understanding what type of business you want to be in. Okay? Would you rather run a high-cost, low-margin business, or would you rather run a low-cost, high-margin business? Now, hopefully you chose the second one, which is this, a low-cost, high-margin business. The first thing to realize is this. If you don't have an exchange seat where you can trade for nearly free, then you should not be scalping or doing more than a few trades every day. Okay? Unless you have an exchange seat, it is almost impossible to make good money scalping. Now, I've held various exchange seats. I still have an IDEM membership. That's where you can trade the Dow for like exchange fees drop from like $2.80 down to 30 cents, different things like that. But you know that costs money. I mean, sometimes it's fairly expensive. So the bigger account you have, the more it makes sense to look into that. I'm not going to talk about that today because that's something where that information is readily available. But if it's something that you want to do, whether it's futures or even in options and things like that, it's a possibility. Just understand that it's expensive. Unless you have a really big 6-figure account or 7-figure account, it probably doesn't make sense in the options world. And in the futures world, like if you trade the E-minis, it makes sense if you do about 20 to 30 round turns a day. Then at that point, you pay like $500 a month, and you can do that. And that's all available on the exchanges. But trading-wise and business-wise, it's much better to have 2 well-thought-out, well-planned trades a week than 3 or 4 hazard trades per day. Okay, this results in better trades and lower costs, thus more profit for your trading business. Okay, again, remember we're treating this as a business. However, if you do like the action and you want to jump into the action, great. Play online poker while you're waiting for your next setup. Taking care of your boredom through the markets is not a good business plan. So commissions. When we start trading options, we all start trading the options on the smaller $20 stocks. But as you trade more, or as you start trading larger accounts, and of course when you start treating this as a business, then you want to take into account the overall income again on the investment versus the per contract basis. So the long story short, part of your trading plan needs to include trading bigger contracts because that is way better for commissions. If you focus on trading a lot of small contracts, you are going to generate, this is for options specifically, you're going to generate a lot of commissions. And it's going to be a burden to running a successful business. So here's an example. 10 spider contracts equal 1 SPX contract. Here's an order to sell 10 spiders. It's going to cost margin of $11,515. It's not a cost, that's how much margin is taken up. And it's going to cost $15 in commissions. Or you could do 1 SPX. It's about the same, $11,501.50. Your commissions are a lot less. Okay? And what happens with this is that over time, this one little change on this individual trade brings in 8% more premium with the same margin requirement. All because you are selling, and of course it works if you're buying too, less contracts and saving money on commissions. Now a lot of times people complain about the SPX that there's a big spread. Well, as a trader, you've got to also understand as part of your plan is not to go in and use market orders. You use the theoretical price. It'll tell you exactly what the price should be, which typically is right in the middle of that, and you place a limit order at that theoretical price, and you'll get in at the same price as you would on the spiders. Okay? That over time can save a ton of commissions. Now, 1 SPX contract equals 1 SPX call equals 10 spider calls. So do you want to pay commission 1 time or 10 times? And of course, 1 NDX equals 10 QQ, and 1 RUT equals 10 IWM. So that's important. If you're trading like say 20, 30, 40 spider contracts at a time, you are just chewing up commissions and your broker loves you. Now, other strategies. Do you want to buy 20 Delta 70 calls at $1 on a $45 stock, or would you rather buy 1 Delta 70 call on a $900 stock for $20? In this case, you have the same profit potential, same cost, same risk, yet 20 times less commissions. Okay, this is important. Trading options, fewer options on bigger underlines, not only give you the same profit potential, same cost in terms of margin in your account or how much money you have to put up for it. You have the same risk, but you have 20 times less in commissions. Okay, and just to be clear, SPX is, you can trade SPX in your IRA, absolutely. Yeah, none of what I'm talking about here is futures. This is all options. If you're a spread trader, this is huge, especially if you've got a big account. If you normally do 20 contracts spread, 20 contracts $5 wide, okay, and by that, let's just use the SPX as an example. So say it's 1680 by 1685, and you're doing 20 contracts, okay, you're doing 20 here and 20 here. Well, you could widen this, instead of it being $5, widen it to $10, okay, and then cut the contracts by half. So now you're doing 10 at 1690 and 10 at 1680. That's $10 wide, and the risk ends up being about the same because you're doing half the number of contracts, okay? And then you've just slashed your commissions in half. And exactly, wider strikes also smooth out the gamma, exactly. So in general, these rules right here will cut your commissions. If you follow these strategies, can cut your commissions by about 80%. That's huge. Think about that. If last year you paid $10,000 in commissions not knowing this, you could undo this, and then suddenly your commissions would be about $2,000. That is a huge, huge expense, and that's all money that drops right into your bottom line. Okay? That's money that goes into your pocket. Now, how about actually reducing your actual commissions? Now, I'm not a good negotiator. I've just discovered that in person. I'm just not a good negotiator. I mean, I'll push a little bit, but in general, I won't go much beyond that. But I'm willing to think about stuff, and I'm completely fine doing it via email. It's just everybody's different that way. So if your broker won't budge, do it by email or do it by chat if they have a chat feature, and some of you guys are really good negotiators, so just call them up and bitch them out. But if you're not, send them an email. Say, hey, I saw this ad for this other broker. You know, the rates are this, and you're charging me this, and I was going to switch to them, but I just wanted to see if you're going to match it. And a lot of times they'll come back and say, well, maybe we can't match it, but we can come down to here, and so you just can work with them a little bit. And you got to remember, the brokerage business is fiercely competitive. They do not want to lose accounts. Okay. If they still won't budge, when you try that, you can, if you're talking to them on the phone or even by email, what you do is just call them back and say, hi, I need to transfer my account to another broker. What do I do? And then they're going to start, well, why are you transferring your account? Oh, I really like you guys, but man, you see the rates that these guys are having? And boy, that would save me so much money. And I might even leave a little bit of money with you guys so I can actually use your tools because your tools are awesome. But I mean, these rates over here are just, that's just pretty awesome. All my friends are moving over there and stuff like that too. And they're going to come back and do something. So that's just, you're running a business, you need to keep your costs down. All right, so we got that. Now we can talk at the revenue. Now, this is honestly very tricky, and I'm not going to lie and say that if you do X, X, and X, you're going to make, exactly this much a year. That's not realistic. So this is tricky because you don't want to limit revenue with daily goals, but you must have a reasonable expectation of revenue so you can plan for reasonable expenses and reasonable risk control. Okay? So in my experience, if you're trading full-time as a business, you can use one of the following revenue models and what I call a reasonable annual return, which is 30% a year. That's 2.5% a month. A moderate annual return, which is 60% a year, which is 5% a month, or an aggressive annual return, which is 120% a year or 10% a month. In the account that you guys typically see me trading, like in the room and stuff like that, that account is on this plan. I'm looking for an aggressive annual return of 120% per year. Okay, and we'll talk more about this. And remember and take it for what it is, which is a projection. Because if you've got an account and your projection is 30% a year, you're going to be setting up risk controls different than if your goal is 120% a year. Now, you may, and I kind of always put in a caveat or more. And this is anytime you have goals, like say whatever your goals are. Let's say that you want to buy a house. Okay, my dream is to own a $500,000 house. Always put or more at the end of it. That means it just opens you up to more possibilities. I want to make $100,000 next year or more. But at least it gives you a ballpark to plan on, and then anything over that is gravy. Maybe you did buy some options on Tesla before earnings and got lucky, and those options doubled your account in one day. Whatever. That or more gives you that possibility. This gives you something to create a business plan around. Okay? Now, part of the reason people will generally ask, well, 60% a year, how come hedge funds only do 10% a year? Well, the reason is the liquidity. The advantages that we have as smaller traders is that we can get in and out of almost anything with liquidity, especially equity options. And you go and look at options volume, it's not like it's millions of contracts. It's on an actively traded contract, thousands of contracts. There isn't room for hedge funds and things like that a lot of times to be in there with size. So as a small guy, we can go in there, we have the liquidity, and with smaller accounts, you can, if you've got the right trading plan, produce decent returns. I like that. Old Indian proverb, better to shoot at an eagle and hit a sparrow than to shoot at a sparrow and hit a rock. All right, so now that's a good question. Are these returns after expenses? I consider these returns after commissions, okay? And then for computers and things like that is what you deduct against that. So by understanding your general goals, you can then set up risk amounts and contract size. Okay? Now think about it. It also determines what kind of trades you want to do. If you have a $100,000 account and you want to make $20,000, which is 20% a year, then all you have to do is collect $82 in theta decay per day. This is actually a very, I hate to use the word easy, but that's not an unrealistic expectation in any way, shape, or form. You don't even have to stare at the charts all day. You're just selling premium, and you're collecting an average of $82 in theta decay per day. And just so you guys know, if you're looking for something like this, and you're looking for something conservative, the best way to do that is to sell premium 60 days out and then buy it back 30 days out. Okay? It's conservative. You're not getting into the options expiration mess or anything like that. This is documented. That could be part of your trading plan. If you want to get a little bit more aggressive and say, all right, well, maybe I want to go for 40%, then you're going to sell 30 days out, okay, and buy back about 10 days out. And again, you're not going for zero. You're not going for expiring worthless. You're going like, all right, I'm going to sell, as a spread, or I'm going to sell it naked for $2 and then buy it back for 40 cents. You do that all day long, okay? So the reason that you want to set a revenue goal is that it gets you clear on your goals as a business. Okay, you're not doing this for the thrills and the chills. You have a legitimate business, and it needs to be run that way. This is a little sign that I like as you're setting up your business plan and your goals. 7 steps to success. Make a commitment to grow daily. Value the process more than the events. And that's pretty key. I'll come back to that in a second. Don't wait for inspiration. Be willing to sacrifice pleasure for opportunity. Dream big. Plan your priorities. Give up or go up. And this is fairly obvious. Value the process more than the events. There's a saying that Steven Pressfield says in his book Turning Pro, and it goes like this. And I love this quote. And he's essentially saying, screw the marshmallows. And what he means by that is that the process and the work is its own reward. If you're more concerned with the material things like, oh, I want to do this, and it's good to have goals like, oh, I want to get a house, I want to get I want to get this sports car and things like that. But you want to get into a rhythm where you actually like the process. I love trading. It's a fun thing to do, and when you can get to the point where you value the process more than the events and more than the rewards, it just becomes, it's kind of like it's its own reward, and then you stop spending money on stupid things and stuff like that too. Don't wait for inspiration. Amateurs wait for inspiration. Professionals do it with a headache. I think that falls across all professions. Be willing to sacrifice pleasure for opportunity. That's pretty obvious. You know what? It's you might have to wait another couple of months to catch that TV show. It's very easy to get into a frame of mind where it's a more, like, oh, I deserve to take time off and I deserve to do this and blah, 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 blah. If you're going to do something great in this life, you need to man up or woman up and focus on it. And it means being willing to say no. If you haven't read Turning Pro by Steven Pressfield, which is a book I highly recommend, if you're having problems making priorities in your life, or you find that people are always, it's like, oh gosh, you're always going to this party and doing that, read this book. It'll change your life. It'll teach you, it makes it suddenly very easy to say no to things that you don't want to do. Dream big. One thing I like is that, somebody who makes $250,000 a year, they do not work 10 times harder than someone that makes $25,000 a year. It's all based on the size of your thinking. A good book on this one, if you haven't read it, is Instant Millionaire. This is also one of the books I recommend. And it's by Mark Fisher. If you haven't read those two, I think they're must-reads. Plan your priorities, that's pretty obvious. And then give up or go up. It's just give up or go up. What's the saying? Defecate or get off the pot. Okay, so for generating revenue, this is the hardest part for people to get a handle on, of course, predict. And I can't predict what I'm going to do any given year trading, but I can have a plan. And the tough thing is you cannot predict exact sales and revenue, of course, in any business. If you start a coffee company and you're thinking, okay, I could probably do $500,000 in revenue, that doesn't mean you're going to do it, but you plan for it. Okay, you hire people based on that projection, and then you got to tweak things along the way. But you can set up a trading plan like a casino, keep it going, and tweak it until you start getting the results you want. And tweaking your plan often means tweaking your approach to trading and tweaking your approach to money management. But if you don't have a plan, you don't have anything to tweak. Remember, the smaller the account, the better the liquidity advantage, something hedge funds don't have. And I know that it's always tough too, is if you're just starting off and you might have $5,000. That's okay. If you have $5,000 and you can prove yourself, and in a couple of years suddenly you've turned that $5,000 into $50,000 or whatever, you can always show that to people and then trade their money. So it's not that you have to have your own seven-figure account. Okay. If you think of it this way, if you get to the point where you've got a track record that you can put together, then if you trade someone else's account that's 500K and you take 20% of that, then it's like you have your own 100K account. Now, is this the best choice? Is this what you should plan for? In this plan, my plan for you is that you just grow your own account, because there's pros and cons of that as well. If you're doing your own account, it's a little cleaner, it's a little bit more focus, and then you don't. If you're managing an account, there's always going to be the pros and cons of talking to people about that. And frankly, the industry makes it fairly tough. If you truly want to manage an account and you want to do one account, that's fine. If you're going to pool a bunch of accounts together, they make it very, very difficult. Okay, is audio still working? Someone just said that. Okay. Now, it's important to understand and figure out what kind of trading you want to do, and you need to figure out what is best for you based on your personality. Okay, this is really important. You need to figure out what is best for you based on your personality. And one of the biggest questions I get is, how do you figure this out? And I found that the best way to figure that out is by studying your losing trades. Your losing trades give you a wealth of information, because your losing trades are a repetition of your personality over and over and over again. Typically when people are losing money, they're doing the same thing over and over and over again. So if you really dig into that and see why you're losing money, and you understand that, you then can start taking advantage of that. And it doesn't mean changing it, okay? So I'll show you my thing. So by studying my losing trades, I know the following about myself. If I like a setup, I will not wait for it, okay? I won't be patient and wait for the perfect entry. I just get in. And because of this, I often take heat. Sometimes it's too much heat, and I get stopped out before the move unfolds. And that's just, and that's no fun. The move takes place, you get in, it pulls back, it stops you out, and then it goes like you thought it would. But that happens. That's part of what happens if you find yourself getting in. Now, it's a strength because I don't miss moves that I see setting up. If I see it, I get in, I catch the move. And it's a weakness because I can get stopped out because I get in too early. All right, so how do I do this? So I capitalize on this natural trait of my personality. This is why I like to scale in, okay? I know I'm usually a little bit early, okay? So if my full size is 10 contracts, I can start with 2. And then if it does pull back, I can add a couple more. Or if it keeps going, I can even add some more. But I know that I'm very bad at getting what I call the perfect entry. So I scale in, and if you can, if you scale in over a couple of different price points, then your average price will typically be pretty good. So I don't mind scaling in at all, but when scaling in, you've got to know what your full size is and what your max loss is. Okay? Now with options, I've learned that my desire to get in the move combined with buying high premium at the money or out of the money options was a disaster. I could be right a lot, but I could still lose money because of theta decay or expiration before the move. And that was one of the things I found is like when I used to do this, say, oh my God, I got to buy these calls, those calls will oftentimes kill me or expire worthless even though I was right on the move. And of course, that's when I just had to start understanding theta decay. So now what I can do, though, is a couple different things. There's a couple different strategies for this that I think are fairly good. So, well, okay, let me get the notepad here. Okay. So, for those of you that trade options, and if you identify with this weakness that I just showed you, here's strategies that you can do. Okay, so the weakness is this, or the why I lose trades. And this is what you want to do. Why I lose trades. Okay, so why do I lose trades? Well, why do I lose money on trades is because I typically, now I'm very good about waiting for the setup, but if I see the setup, I jump in. Okay, that's my weakness. So, how to handle? I could say, well, stop doing that, John. Well, but that's my natural, that's how I like to trade. Okay, so if I try to stop myself doing that, that's going to be very difficult. So how do I take advantage of that? Okay, 1, scale in. 2, and let's just say that this is a bullish move. So 1, scale in. 2, sell at or out of the money puts. That could be naked or a spread. Y, theta decay. And then 3, and this is what I like too, is I could instead just buy a 1 strike in the money debit spread. Now, I actually really like this strategy. So what happens in this type of strategy if you do this? We actually tried this in Tesla in the room the other day. So if you do this and say, like, all right, you're looking at a stock and the setup, a setup is typically like a squeeze, and here's a squeeze, and the stock's starting to run. I'm like, oh my gosh. So I go ahead and here's we'll use Tesla as an example. So here's $150. Here's $155. Here's $160. 145 and 140. And at the time I see this trade, we're at whatever, 148 bucks. And the premium is high, so we can say the $150 calls, the $150 calls are trading for, $2, and the $145 calls are trading for, $4.50 or whatever. So what you can do on this then is like, wow, I think this thing's going to go. So you buy a debit spread, and then if it just keeps going, that's fine. You make the spread. But if it pulls back, guess what? What's going to happen is that maybe this drops to 80 cents, and then this drops to whatever it is, $2. Obviously, that's going to drop. Then at this point, what you do is you buy back the short side at 80 cents. So you just made $1.20, and then you can use that to buy more calls here. Okay, if that made sense. Now remember, I'm not going in with full size. Okay, I've got more bullets in my tank. But what I'm doing with this is that if it just takes off, fine, I make the spread. If it doesn't, I buy back the short side, and if this is a good support level, I can actually add to it. Okay, all right. Good question. Are we going to be taking a 5 or 10 minute break? That's a great idea. Let me see where we are here, and we'll. Actually, this is a perfect place. Okay, so let's do this. Let's do a quick break. It is currently 1:22. Let me get that thing here. Let's take a 32, 35. Let's take a 12-minute break. We'll start again at 1:35 Central. Okay. So let me just check real quick on the questions. Yeah, so one thing, if you incorporate it in a different state, you do need to pay a, it's like an annual recurring fee for a presence there, which is like an address, which is, yeah, an unnecessary cost. Can you talk about charitable trust accounts and tie this in with the LLC business? Thomas, I would, but I have no clue how that works. But that would be a great question for an accountant. Oh, mastering the exit, interesting, okay. Yeah, okay, so here's a reasonable question from Mac. Is it out of the question, could you ask folks to check in and you're talking about TOS specifically, just what they pay. And someone here is just asking, what is everybody paying for commissions? Yeah, no worries. Yeah, so a lot of, yeah, $1.25, $1.50, bigger account, 75 cents, dollar, $1.50, 75 cents on Interactive Broker. Josh, that's good. I know there are firms out there that have very low fees, like 20 cents, stuff like that. I can't remember the one it was, but what I found for options, anywhere, the norm right now is about for a small account that's not doing very much, about $1.25, $1.50 to $2 is kind of the default range, and then from there, as you get a larger account trade more frequently, it goes down. All right. Okay, so let's do this. We got a lot to cover still, so let's dive in here. And again, I'm going to shy away from talking specific strategies here, like, hey, this is how to trade options, because we've got so many excellent courses on that. So it's really, we're going to get back and just really focus on the plan. This is the plan to take those setups and turn this into a business and be able to make money with this. So going back to my trading was, so now that I know my weakness, and my weakness, as we talked about earlier, was I get into soon. And it's interesting, somebody in the room made a comment, it's like, yeah, when I'm watching you in the trading room, I've picked up on that, and I kind of try to see, like, okay, is this, and then there's sometimes just knock it out of the park. So it's just like, all right, is this one that John got into early, or is this one that he's nailed at the right time? And so now what I try to do is, on a bullish move, is look at selling puts, because that way it can be extended. You sell the puts, and as it pulls back, you still make money on the trade, which is fantastic and is a good business practice. So in this way, I can still be early and still make money on the trade. Options are a miracle if you understand them, and a disaster if you don't, period, end. Part of any trading plan should be to include having theta decay in your favor. So if you've never sold options, if you've never sold spreads, if you've never sold naked puts, I think it's critical that you do understand how to do that. Again, I'm not going to talk about that here because, of course, we have classes on that, but it does give you an edge. Okay, and you don't need a class to do it. I mean, you can Google it too. And by Google, I mean Google the definition. It's not going to show you how to make money doing it, but at least you'll understand what it means. Okay, so what is my specific trading plan? So my main business account, and by business account I mean the account that I want to set up and treat it as a business, is the one that and this is the one that I pull money out of. Okay, like I have other accounts like an IRA, I want that to grow every year, and I can't really pull money out of it. But this account, I have a very, very specific plan, and I use this one to generate income, and it's the one that I trade in the room, and it's a 7-figure account. So how exactly do I do this account, and what is my plan? First of all, and this is something I've tried this year, and I like it a lot. What I used to do was manually wire money out. Like, okay, I made this much, and I'm going to keep half the profits, and it kind of became something that sometimes I'd forget to do, or sometimes I didn't want to do it. It's like, well, gosh, you know what? I made, 5K this week. I want to keep it and turn it into something bigger, okay? And so then I started doing an auto wire. And every week this goes out regardless. This goes out on Thursday as an ACH payment, which is free. So it goes out every Thursday, and then it's in my account Friday morning. My account, my checking account. And I generally keep this at 2 to 2.5% of the account balance per week. Okay? And then I try to keep it as a Fibonacci sequence number, but that is obvious. That is sometimes tricky to do. So let's take a look at this. So I just took a screenshot this morning, and this shows my weekly wires. So for a long time this year, I've been doing $25,000, and that's not quite a Fibonacci sequencing number, but 2 is a Fibonacci sequencing number, and so is 5, so 25. And so it's 25,000, 25,000, 25,000, and then I recently upped it to 34,000. And that's, of course, a Fibonacci sequence. And honestly, the jury's still out on this. 25,000 to me, I had my head wrapped around. For that account size, this was pretty easy. I didn't really have to think about it. 34 is kind of like, oh man, I gotta focus on this. And so I'm gonna try one more week and see. I may drop it back to 25. But the key is that it's flexible, but that it's also automatic. And here's what I found that this helps me with, because what happens is, in lieu of, and the goal in a perfect week, what happens, okay, and let's say like here, $25,000. And I remember actually these weeks here. So in a perfect week, what happens on something like this is that, let's say you make, now remember, and don't get too caught up on the dollars, think about percent. So this is an account that's got like $1.4 million in it, okay? So if I was talking about an account that had 140,000, then we'd be just doing it, by 10, it'd be $2,500, okay? So just think of it in terms of percentages. But what I want to talk about is what I have found that works for me after doing this for a long time, and that's honestly, I think, the trickiest thing to find is the thing that works best for you. So in a perfect world, what happens is I make $35,000 in a week, which is on 1.4 million, about, oh gosh, ballpark, what is that, about 2.5% or so, and this is back here. And then I wire out 25,000, so I make money that goes into my account, and my equity has increased by 10K. Now, when I'm talking about an equity curve that goes from the upper left, from the lower left to the upper right, that includes this money that you're wiring out. Those are profits. So even though your account balance, and it's important to track this, even though your account balance may drop, this is part of your profits for the year. So there's kind of so there's essentially, if you're doing this, you're actually going to have 2 equity curves, and it's going to be, and as you're tracking this, you're going to have equity curve A, and then you're going to have equity curve B. And equity curve A is the total amount that you make, and this is account balance plus money wired out. And then you're going to have equity curve B, which is your remaining account balance, which you also want to climb. So for me, in a perfect world, what happens is that I go through the year, I'm able to wire money out that I can use to live on, okay, and my equity continues to grow. And in the psychology class, I talked about the whole issue of, and there's a couple things at least this helps me with. One is that if you're just trading, and especially as you get into larger numbers, sometimes the numbers become meaningless, and I know in my case, you can just just either start getting bored, or looking like just not really planning trade size, okay? But what I know is that I'm going to be setting up my trades, and I do know that, if there's not much going on that week, at least I want to try to make $25,000, which in this case is about 2%, and that means I can sell some premium. I can sell 100 contracts of Tesla at $1.25, and if that works out, there's $10,250 of that $25,000. Okay, if there's nothing else going on, and then sometimes there might be a good move like USO, and I catch that, and it's just this great great open profits, and I still bam wire that out. So you've got to see how this works for you, though. For me, it's actually an incentive. It keeps me on track. It keeps me grounded, because my goal is to make money, make enough money to at least pay for the monthly VIG or squeeze or whatever you want to call it, and continue to grow from there. Now, do I make money every week? No. But even if I lose money, and this is the trick, even if I lose money, the money gets taken out. So the goal is, and of course, now if you're in a situation where you're losing money every week and you're wiring money out every week, that's not sustainable. That's why you got to put together a trading plan, right? So what I think this does, at least for me, is it forces me to think in terms of this being a business. This is a real expense. Now, when the money goes into my account, I can do with it what I want. I generally put it into longer-term investments. I use some of it for fun and things like that too. So, and I'll tell you these weeks here, and this was interesting because this was, so I went to Cayman's. Here I was in Cayman's. And then here, this is before I went. I remember these weeks, so I'll do these columns here for you. So this is total profits for the week, and then this. So I remember, like, I think it was like this week I made like 35K, and so I was left over with 10K after we wired this out. Gosh, there's a couple in here that were really good. But I'll tell you this last week here is I ended up losing about 40K. Plus, I wired that out, so my account went down by 74K. Okay, and then I know this here I made, it was like 38K, so I ended up with 4K in my account. And then this was like, I remember this week was really good. It ended up being like 90K total. So after this, it was 65K in my account, et cetera, et cetera. But what happens is that the goal is that you're taking money out of your account and you're also growing your equity. What I like that even doing this on losing weeks, it keeps you focused on the business. Now, can you do this every week for 6 weeks? No, that's unsustainable. But it keeps you, what I find is it keeps me focused. Okay, so it's kind of your call on how you want to do that on a losing week, but I found it keeps me focused. So my goal on this account is 120% annually. I auto wire out about 2% a week. Obviously, that's going to fluctuate based on the equity. But the goal is as follows, and I'm going to use $100,000 as an example here. This essentially is my business plan, but I'm doing this with a 7-figure account. I want to start the year with $100,000, be able to wire out $100,000, and have my account balance at the end of the year be $120,000. So what does that mean? That means a goal of 120%. So if you had a $100,000 account and you made $120,000 or 120%, that means you made $120,000, and that would bring your equity to $220,000. So of that, you took out $100,000 in profits, and you're left with $120,000. Okay. So this is essentially the basis of my plan. Now, that's what I do. You may want to sit there and go, okay, I like that idea, John, but I'm going to do it with 30%, okay, or I'm going to do it with 60% as my goal, and that's fine. You just cut the numbers appropriately. If you have an IRA account, obviously you're not going to be wiring money out unless you're you reach the area where you can do it without a penalty, and that's fine. As an IRA account, you would essentially do the same. You can do the same thing, except you're just essentially leaving the money in. Okay, in an IRA account, I mean, that's just kind of what you have to do, unless you're at a point where you can actually start taking distributions. Now, here's one thing I want to tell you guys as well, because I know, and I go back and forth on like, okay, should we, because sometimes, especially if you're not used to a larger account, that can almost seem unrealistic. It can almost seem like it's unachievable. But I started doing this about 15 years ago. and I did this with a $25,000 account. That's when I first started doing it. And not to auto wire, I did it a little bit differently. I went through a couple different phases where I thought, okay, I'm just going to keep $25,000 in my account, and at the end of the week, you know, if I had, say, $26,300, what I would do is wire out $1,630. In fact, what I did is I kept my capital the same. And so at the end of the next week, if I had, you know, $25,032, I'd wire out $32. And then if I had a losing week and say I ended the week at $24,350, what I would do is the account that I was wiring money into, I would put back in. So in this case, plus, so I'd have like minus $650. It would go back into the account. So on Monday, I could start again with a $25,000 balance. And I did this for a couple of years. And the idea here that I was trying to overcome is I didn't want to have the issue of feeling like I had to come from behind, okay? And I wanted for me, this worked perfectly for me for that time in my life. I had money that I was wiring out. I was focusing on the trading, okay? And I know a person who does this every day. Like they actually wire money out every day or wire money back in every day on a $25,000 account. So there's a lot of different ways to do it, but I think it is critical if you've got you know, like a normal non-IRA account that you do this, because then you're treating it as a business. And if you've got an LLC, guess what? Under the LLC, you can have two accounts. You have your trading account and you have your checking account, and they're both under the LLC. And guess what? You can wire money out of the trading account into the checking account, and that's still part of the business. You then can use this money to go buy things that are tax deductible. And again, the whole idea is suddenly treating this like a business. Now, at some point, so then the question becomes, okay, at some point, like, why do I do what I do now? At some point, I've tried a couple different things. And at some point with a 25K account, I wanted to grow it. Now, I've talked about in psychology the plateau, and the reason I did that because every time I got to $40,000, mentally I would plateau there. Like I couldn't get through that, and so it would come back down to like 25K. And I noticed this every time I got to 40K, and come back down to 25K. So I just started wiring money out, and this is just a mental block. I don't know why. Who knows why we have mental blocks about money? But that's the other strategy, is doing something similar to what I'm doing now. Is that when you reach a goal like this, say you have 25K and it gets up to 40, and you notice this, well then when you get to 40K, take out half the profits. So that's 15,000 in profits. Take out 7.5K, and now, so you wire that out, and now, you know, then you have your 25K plus 7.5K in your account, and then you go to the next level. So there's different levels to do this, but as a business, I think it's very important to do this and to find something that works for you. And so what I've done is I've shown you the three things that I've done, which is one, which is the current auto wire every week. Two, the plateau method, or the weekly goal, leaving your account the same in each time. And then three is the plateau method, which I've talked about extensively before, where every time you get to a plateau, instead of losing the money back to your original balance, you take out half and then try to reach to a new plateau. So these are all money management strategies that are excellent in terms of running a business, because you're pulling cash out of the account. You use that cash to go buy things, and if they're related for your business, you can then deduct them in your trading company. So that's a good question. Are profits only on closed trades or on the increase in value of your account over the week? Okay, and that's a great question, and here's a term I want you guys to understand, and that's NLV. That is net liquidating value. That's the only number that matters. And that means that's the total balance of your account, including open profits and any positions that you have. So I base it on net liquidating value. That means if you sold everything and went flat, that's how much your account would be worth at that point. All right? Okay, so now let's look at the numbers here. Now, I like Fibonacci numbers. The question is do you have to use Fibonacci numbers? Absolutely not. It's just a thing I have. The more you look at, or at least the more I look at and understand Fibonacci numbers, the more beautiful I think they are. So I like to try to incorporate these into my method. So I was using 25K for a while. That's 2 plus 5. I'm now using 34K. The jury's still out on this. I may, find something like, I don't know. You want to find a number that you don't stress about. And I got to a point where 25K, which was about 2%, wasn't stressing me out. 34K, I'm finding I'm thinking about more. So you want to get a number that you're comfortable with. So if you have if you've got a 20K account, and we're talking about 2%, that's like $400. You don't have to start with that. Start with, especially if it's an ACH payment and it's free, start with $50 and see how that feels. If that's like a no-brainer, see how it changes you mentally in terms of starting to treat this as a business. Then increase it to 100. But I don't think you ever want to increase it more than 2.5%. And if you have a really good week, you can actually, bonus, take it out if you want to. But what I found is that this gets you in the right frame of mind to treat this as a business. And, if the number is 144, it's the 144 Fibonacci sequencing number, you can use $144, $1,444, $14,440, etc. And again, you don't have to use these numbers. I just do. So if you had for your business plan, your starting capital is $100,000, you could start with $1,597. That's a Fibonacci number, okay? Or if you want to give yourself a little time to see how it feels, start with a lower one. Start with $610. Start with $377. Remember, as your account grows, thank you, as your account grows, okay, your percent will increase. So even though you would need to make about roughly $2,000 a week to accomplish this goal, give or take, or $1,923 a week. So essentially to make this goal, you'd need to be able to pull out $1,923 per week. Well, guess what? As your account, increases in value, you'll be able to increase the wire out too. So again, starting capital $100,000, ending capital $120,000, money pulled out of the business is $100,000. That's a 120% annual return, okay? So again, real quick on the math. So you start off with 100,000, you make 120%, which is 120,000. Over the year, you pull out 100,000. You're left with 120,000. So you made 120%, and you kept in. So you made 120% on your original 100,000, and you left 20% of that in, essentially, to continue growing your equity. And what happens with the situation is over time, say you do this 5 years or 10 years, over time, your equity grows and your income grows. And that's how you develop a business with growth projections and revenue and stuff like that. When I used to do this, it was a $50,000 account and then a $100,000 account. Okay, and now it's 1.4 million, and I'm trying to. My goal is to get that to 2 and be able to pull money out of that while I'm doing it. But isn't 120% a year a bit of an unreasonable goal? I actually don't think so. I think that's all mental. But you've got to find something that you're comfortable with. If it's not comfortable for you, start with something lower. Remember, if you want to make 20% a year, all you got to do is on a $100,000 account is make 82 bucks a day. And what happens is most people lose money because they don't have a trading plan in place that works. All right, which is what we're going to start talking about next. Yeah, and if you have different accounts at different brokerages, you can actually, that's fine. You can use, you have 3 accounts, you track the setups in each one, and that's completely fine. Okay? But let's talk about trading. And if you are not making money now, then you either don't have a plan, or you have a plan and you're not following it, or you have a plan and the plan isn't working. Okay? So either 1, you don't have a plan, 2, you have a plan and you aren't following it, or 3, you have a plan but it's just not working. Of these 3 situations, number 3 is great. You're on the right track. Because as long as you have a plan, you have something to tweak until it starts working. And as Mr. Einstein said, we cannot solve our problems with the same thinking used when we created them. And if you're not making money trading right now, you need to examine your losing trades